Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo podcast, in which we review the market news for the previous week and offer some forecasts for the coming week. I'm Christopher C. Smith.
And I'm Robert Coburn. And this week, we had more huge volatility in the stock market as investors swung wildly between optimism about government stimulus and pessimism about business closures. Monday, I figured the country was about to as locked down as it was going to get, but government officials proved me wrong by locking it down even more over the course of the week.
Yeah, it's looking bleaker and bleaker out there, Robert. We started the week with a huge drop, with the major indexes down nearly 13%, which is a huge drop. The sell-off happened despite an emergency Fed decision to buy $750 billion of bonds and cut interest rates to 0% over the weekend. I think the reason the sell-off happened was because over the weekend we saw massive business closures nationwide, including the closure of Apple stores across the U.S. Apple was one of the big losers on Monday. And basically, we just saw the transition from sort of partial lockdown to a total lockdown of the country, essentially.
Yeah, and then Tuesday, the indexes gained 5 to 6% as the Trump administration worked on a $1 trillion stimulus package that will include checks sent to individual Americans. However, retail sales data for February showed a larger than expected contraction.
Wednesday, we erased all of the previous day's gains. Oil led the way down with an absolutely massive drop over 20% as the price war escalated between Saudi Arabia and Russia. At its low point for the day, oil hit $20 per barrel, which is insane. Just a few months ago, we were well over $40 a barrel, so we've more than cut in half the price of a barrel of oil. And energy companies like Chevron and ExxonMobil obviously took a big hit on Wednesday.
And then Thursday, the market rallied slightly, with crude oil prices partly recovered from the previous day's drop on speculation that Trump would intervene in the Saudi-Russian price war and convince the Saudis to back off. There was some drag from economic data, however, because jobless claims jumped more than expected in the second week of March, and manufacturing has contracted more than analysis expected this month.
Yeah, and then Friday we got another 4% sell-off despite another $1 trillion of overnight repo from the Fed and more promises of bond buying. Partly the sell-off was driven by a statewide government order in California for all residents to stay home except to walk the dog or buy groceries and medicine, which effectively constitutes a total shutdown of the California economy.
Yeah, and then one of the stories we've been watching very closely here at the Wall Street Petting Zoo is deflation in the dollar. In just a few weeks, the Fed is doing the same amount of quantitative easing it did over many months in 2008. They're injecting trillions into the repo markets and buying hundreds of billions of dollars of treasuries. They set up a commercial paper facility to loan money to corporations, and they're talking about buying as much as 4.5 trillion of corporate bonds. They've also bought 200 billion of mortgage bonds in an attempt to push mortgage interest rates down. Ordinarily, printing that much money would cause massive inflation, but right now the opposite is happening. There's so much demand for cash by overtaxed lenders and stressed companies that there's been massive deflation happening all week, and nothing the Fed has done has slowed it down. There's a huge shortage of the US dollar out there, and a few bank branches have literally been unable to cash paychecks because they ran out of cash. Until something changes, the US dollar is one of the best performing investments out there, so hang on to your bucks.
Yeah, and then as far as stocks and equities, it looked midweek like the market might be finding a little bit of support this week as the pace of business closures slowed down. And we also saw some divergence between the stocks that seem to maybe benefit from this environment, like the e-commerce stocks and the consumer staple stocks, and the rest of the market that is being hard hit by this. But I wouldn't be surprised next week to see a continued market drop. We may start the week with a rally because it looks like the stimulus package being discussed in Congress is about twice as large as originally contemplated. They're talking about $2 trillion rather than $1 trillion, which is about 10% of the US's annual national production. So that is a huge stimulus package if it materializes. But I'm still not sure that that is going to fix this thing. I'm not sure we have any real understanding yet of just how disruptive this is going to be, especially if these quarantines continue for another, several months. Delta Airlines is burning $50 million per day, just to show you one example of how big the impact on corporations is. And then the labor market is also hurting. There are layoffs all over the country. New York's unemployment office is reportedly getting 200,000 to 500,000 new contacts a day. California saw unemployment claims jump from 2,000 to 80,000 overnight. Employees at these unemployment offices are working 4 hours of overtime every day just to try to keep up with the flood of the claims, and they're still behind. Last Thursday, our weekly jobless claims number was 280,000 for the week. This Thursday, it will probably jump into the millions. The estimized consensus for jobless claims this week is 1.1 million. And some of the more analyst estimates, the more accurate analyst estimates that I follow are putting it much higher at like 2.5 million. My forecast is kind of in the 2 million range. So we could see like much worse than expected jobless claims numbers this week. So the biological crisis has sort of stabilized. The news environment there has sort of stabilized because we've got basically the economy is shut down at this point, so we're not going to get further business closures. But the financial crisis is just beginning. Stimulus by the Fed should help prevent outright bank failures, but there's still going to be a lot of pain in the banking sector as mortgages and corporate debt start to default. And the canary in the coal mine for a mortgage default crisis is unemployment. So we may see something akin to panic in banking stocks like this week as the unemployment numbers get released on Thursday and sink in. All right, let's talk stocks that we watched this week. Robert, what were you watching?
So last week, I was looking at my old good friend Activision Blizzard. I was also watching them along with Zynga, where both ended the week only slightly lower than entering the week, with the successful launch of the Call of Duty Battle Royale mode Warzone and the upcoming release of the latest World of Warcraft expansion. I believe we'll see a much higher MAU, which is monthly active users, than we have seen in previous quarters. For those who haven't previously listened to the podcast or those that don't follow gaming stocks, MAU is typically what measures a successful gaming company, whereas most SaaS companies look at EBITDA. Tencent, which has a leg in the gaming industry, they also released quarterly earnings that beat expectations this week, but they lowered guidance, citing that the COVID epidemic preventing companies from deploying to the cloud. I think Tencent, along with its messaging and payment processing legs, is setting itself up as a future mega conglomerate. And after announcing his departure from the board of directors for both Berkshire Hathaway and Microsoft, I was kind of intrigued to see how the market would react to such news. But for
Bill Gates, right?
Yeah, for Bill Gates. But for the most part, the stocks stayed relatively the same. Usually when there's a change in leadership, especially a big name like Bill Gates, you tend to see a knee-jerk reaction, but this wasn't the case. And lastly, I was watching WWE. This week, it was announced that WWE would not be hosting their annual WrestleMania show in Tampa. Instead, it would be hosting it at their performance center in front of no crowd. So this is a huge hit on revenue for the WWE. But I would think, and most would think, that this would cause the stock to tank even further than it already has. If this stock has been beaten down from, I think it was almost to $100 this year, and now it's already, or last year, and it's already down to $33 right now. But the stock actually ended the week 6 points higher than where it started, so it's actually doing better than a lot of people anticipated.
This market has been really hard to predict. I mean, stocks that I thought would do great have been failing, and stocks that I thought would fail sometimes have been doing fine. So it's hard to call right now. It's just so volatile out there. Last week, I said I was pretty much staying in cash, but I called out a couple possible speculative plays that I thought might do well. Tegna had a few $20 per share buyout offers, so I thought, it looked like a bargain at $16 to $17 per share. Well, it has fallen down into like the $12 per share range. So I think probably the market is pretty pessimistic on these deals actually going through, given the environment out there. So maybe they're just not expecting those deals to materialize. But in any case, it did not do what I expected this week. It did not move higher toward that $20 per share price. And then Opco Health was another one that I was watching. Opco is a maker of coronavirus test kits, and given the shortage of test kits out there, I thought that it would probably move up. It did the opposite. It moved down like 25% this week. I think possibly because of the amount of competition out there. Opco's test kits reportedly take like 2 days to return a result, and there are some makers of test kits out there that are supposedly delivering results faster. So I think Opco just isn't getting it done given the competitive environment here. I did see over the weekend they signed a deal with New Jersey to supply test kits for New Jersey. So it's possible that Opco will see a rally Monday morning, but they certainly didn't do well this week. Let's talk stocks we're watching this week, Robert. What are you watching?
Well, I'm kind of starting to look for my way into the market, but with so much volatility, it's definitely not something I want to bite my way into. So one ETF I'm eyeing that I'm probably going to go in on when there are signs of improvement is Pez, like Pez dispensers, but it's not actually the company Pez. It's an ETF which has holdings in Dollar General, Ross, Costco, and Target. I don't want to bite into these just yet because the market does have a long road ahead to recovery. And I've been hearing one heartbreaking story after another of people losing their jobs on social media. So I believe this market is going to go even lower than the levels we saw in 2008. And we haven't even reached 2008 levels yet. So I agree with Chris right now that, cash is king right now.
Yeah, I've been thinking along similar kinds of lines. I still think you're best just staying out of this market. Hang on to those precious US dollars because, like I said, they've been one of the best performing investments this week. There probably will be more repo by the Fed, and we probably will see some weakening of the dollar as sort of the rush for cash tapers off a little bit. So I don't know that the dollar is going to continue to deflate like it has been, but it should remain relatively stable because in a recessionary environment like this, the demand for cash is going to be pretty strong. Next week, I think we may see an attempted rally early in the week, Monday morning. If Congress gets this stimulus plan passed over the weekend and it is bigger than analysts expected, it turns out to be a $2 trillion stimulus plan rather than a $1 trillion stimulus plan, then I expect that we will see an early week rally on that news. But then I think we will see buyers capitulate midweek and the market continue downward because with all the layoffs this week, I think we'll see unemployment numbers skyrocket. We'll see, much worse than expected jobless claims on Thursday. And we will see a bit of a panic as people consider the possibility that this biological crisis is going to quickly turn into a financial crisis. I think that it's possible that a few sectors and stocks will gain as the market falls. This week, we saw a pretty strong performance from FedEx and UPS. Partly that's because fuel prices are extremely low, and FedEx announced that demand has been quite strong in the first couple weeks of March as people are ordering a lot of stuff online and having it delivered to their homes. So we could potentially see the shipping companies, the direct-to-consumer shipping companies like UPS and FedEx outperform. We've also seen pretty good performance from the consumer staples sector. Companies like Kroger and Costco have been beating the market because of all the panic buying. People, are eating at home a lot more, and so they're needing more groceries. And also providers of remote work software like Zoom and Cisco had a fairly strong week this week. Streaming services like Netflix, video game stocks like Activision. These are all stocks that could outperform in a recessionary environment like the one we're in. But you know what? If the market breaks support next week and continues down, a lot of these stocks will probably fall with it. So I still think you're best just sitting out. I don't usually recommend playing the market short because there's just too many interests that want the market to go up. And so there's always like stimulus packages and things like that to try to help bolster the stock market, even in an environment as negative as this one. But you might consider a speculative play on FAZ this Wednesday. That's an inverse ETF that tracks the banking sector. So when banking goes down, this ETF goes up. If you enter Wednesday and the jobless claims report comes in really bad with multi-million new jobless claims on Thursday, then I think we could see kind of a minor panic in the banking sector on Thursday, and we might see this ETF get a nice pop. Right now it's at $65 per share, and I wouldn't be surprised to see it rise to $80 per share by the end of this coming week if jobless claims come in as bad as I expect. Although, as I said, look for an early week rally, so don't get into this short ETF too quickly, because I think probably once we get news of that stimulus package, there's going to be a small rally before it heads back down again. All right, guys, to play safe out there, don't play with your grocery money. I mean, this market is too volatile, too unpredictable. You don't want to get stuck in a bad trade out there, because the swings could take your bet in completely the wrong direction very, very quickly, and you don't want to lose money that you actually need to get through this crisis. So hang on to your cash. You may need it before all of this is over. Remember, you've got to sit at home for a couple of weeks or potentially a couple months. So you're going to need your resources probably. So don't play safe. Don't get too risky out there, but there are maybe a few opportunities to nibble here and there if you have money to burn and you can tolerate the risk. So just be careful. Robert, you want to say anything to folks before we sign off here?
Yeah, wash your hands and stay indoors. Do not help spread this. As we've seen in Italy, it can get really bad really quickly. So, take care of not only, you yourself, but take care of your family, your friends, and then especially the elderly who are at most vulnerable to this. So stay safe.
Yeah, take this seriously, guys. I see a lot of people out there still thinking that this isn't as serious as it's being made out to be. It actually is. It's a really serious situation, and so we want everybody out there to stay safe and stay careful. All right, thanks so much for listening. If you heard something useful on this podcast, please consider giving us a like, share, or comment on YouTube. If you've saved money in this crisis because we told you to get in cash a couple months ago, maybe a good time to tweet at us, give us a shout out on Twitter, or tag us on Facebook and let your friends know about the podcast. We also have a referral link to Webull underneath the YouTube video. If you want, you could open up a Webull account and put in $100, and that helps us support the podcast. And we get some free stocks, and you will get some free stocks, and it's great for everybody. And that way you can be ready to finally enter the market whenever this recessionary situation starts to pass and the market stabilizes or reaches the bottom a little bit. We'll keep you updated on that so that you can time your entry. In the meantime, guys, stay safe, and we'll see you back at the zoo next week.
See you.